going to go ahead and get started because we have a very full 2-hour period. If I recall from the last time we taught this class, we went over. So, right? It's not your fault, Mary. It's not your fault. My name, for those of you that don't know me, which I don't think there's anybody knowing that doesn't know me actually, is Jen Bonet. I'm a community catalyst here at ATDC. I run the Lunch and Learn programs, and I'm in charge of the mentorship program. Today we are this is the first in a 3-part workshop called Financial Literacy for Startups. So what we're going to be focused on over the next 4 weeks, because we're off next week, it is a holiday, 4th of July, on Wednesday. What we're going to be focused on is giving you the tools that you need to create what we call a bottoms-up financial model. Okay? So I'm going to kick this off, and I'm going to talk about why it's important as entrepreneurs to have a financial model. And then I'm going to turn it over to my co-conspirator for the next 4 weeks, Mary Miles, who's one of our mentors and coaches, who's an expert at all things finance. And she'll tell a little bit more about her background when she gets up there. So today is kind of the baseline, right? We need everybody to be on the exact same page for the next 2 weeks, right? The next 2 weeks are kind of how do we actually build a model and rolling your sleeves up and building that financial model. So for this week, actually, we're going to actually just pour a lot of information at you so that hopefully everyone in here has a basic understanding of basic business finance and finance terms. Okay, so why are financial plans important? Okay, so financial plans are about telling your story in a numbers perspective, right? One of the hardest things that I've learned over the last 3 years is, and this is mostly through Startup Chicks, but some here at ATDC is, almost everybody wants to raise money, right? How many people in the room want to raise money? Okay, right. So, but as entrepreneurs, we're like super passionate about our idea, but the entrepreneurs only care about one thing, and that is how much money you're going to make and what is the return on investment going to be. Okay, so the financial model and is where you are going. This is your plan. This is your projections. Let's be honest, it's a guess, but it is your plan as to where you're going. Your financial statements, if you've been in business for a couple of months, 6 months, a year, are your story of where you've been, right? And the two together tell the overall big picture of why you might be a great investment. Okay. On top of it, it's a roadmap for your business, right? So there's a handout, I think the top handout, right? This is actually out of Inc. magazine in March of this year. And it's, you can read it at your own leisure. It's about living social. So pretty cool startup, right? It's about, he uses his model and his metrics that he looks at every single morning. Every single morning at 5 o'clock in the morning, he gets up, and the first thing he does is look at the numbers that came in yesterday. And then he makes decisions about how to act on his business today based on yesterday's numbers. So he's not waiting 30 days to say, month end, we did good last month. He's looking at those numbers every single day, okay? He's looking at the key numbers, the key metrics every single day. One of the key things and one of the hardest things to understand is what is the lever that's going to make you succeed or fail? Right? What is the lever that's going to make your business grow fast? Right? So a little story here, and we'll get more into this next week because we're going to actually look at the Next Fence financial model. My last startup was a subscription-based software as a service mobile app. And I thought the lever would be subscriptions. Well, it turned out for the first 3 years, ad revenue is what drove our bottom line, not subscriptions. The free users that were using it and seeing a single ad every time they launched the app was actually generating more money than subscriptions could possibly generate for us in the first 3 years based on our financial model. And the only reason I knew that was from the financial model. I would never have guessed that had I not gone through the exercise of creating a bottoms-up financial model. So this financial model, this really complex spreadsheet that you're going to build, will help you identify, as you play with the numbers, what your key levers are. And there may be some surprising things there for you. Right? Okay, so, a tool, the financials are also a tool to track and manage your business. Like I said, Living Social, the guy looks every single day, right? As a web or mobile software-based company, there's really no reason not to look at your numbers every single day, right? If you wait till the end of the month, you may have lost 30 days of revenue, and you could have done something to change that or fix that. You might not see the problem. So this is a way to actually manage your business, right? To track. As we looked at Nexpense, I thought we'd have 200 users in the first 30 days. We only had 100. Well, my whole financial model's wrong, right? I got to keep on top of it. I got to keep changing it. But guess what? In the next month, instead of having 200 new users added, we had 600 new users added, right? So it's what's happening over time. It's something that you want to keep up to date and keep working with and use as a measurement to know whether you're on track. The other thing is, I personally live or die by my cash flow statement. The reality is, I want to know how much cash we have at any given point in time, right? What's our runway at any given point in time? What's the cash flow? What's coming in? What's going out? What's our runway? How many more months do I have until I run out of money, and I either have to have enough sales to cover our costs, or I have to find an investor, right? So I manage on a day-to-day basis my businesses from the cash flow statement. Okay. We're going to talk about building a bottoms up, right? So we're going to talk about identifying what your expenses are. We're going to identify what your revenue streams are. We're going to identify what your cost of goods sold are. Okay? And we're going to talk more about those terms. But we're not going to say, well, we're going to get 2% of the market, and that's how we're going to say how many new customers we add every day. We're not going to do that in this class. What we're going to talk about is, ooh, that's not good. What we're going to talk about is, wrong one. What we're going to talk about is, how do I get to a reasonable metric of how many new customers I'm adding every month, right? That I can build into my plan. And those assumptions might be, I have an inside sales force, and they're dialing for dollars. And one person can make 20 phone calls a day. And out of those 20 phone calls a day, they're going to get 2 leads, 2 hot leads, prospective clients. And out of those 2 prospective clients that they get every single day over the course of the month, they're going to close 7. And that's how I know I'm going to add 7 new customers this month. We're going to go from that level up, not just say, oh, we're going to add 200 new users a month, okay? For those of you that are web-based solutions or mobile apps, we're going to help you try and figure out what your cost per acquisition is, right? So I know at Nexpense my cost per acquisition was $6, right? So for every $6 I spent on advertising, affiliate partnerships, programs, email campaigns, whatnot, I got a new member, right? So that's the number that drove my new acquisition. So we're not going to just come and talk about, we're going to get 2% of the market. We're going to actually build it from the bottoms up. We're going to look at the assumptions behind the numbers, and we're going to document them, because any investor is going to want to see that. We're going to build, I think we're building 3-year? Is that financial model 3? We're building only 3 years. Some investors may ask for 5, but once you learn how to build a 3-year, you can learn how to build a 5-year. We're going to talk about your costs too. We're going to talk about what do cloud services cost, and how do you project cloud service costs and things like that. We're going to talk about, we have a financial model that we're going to share with you, and we're going to allow you to use, that actually separates everything into tabs. So like headcount is on one tab, expenses on one tab, and it just makes it easier to track things. And then sensitivity analysis is a tool within Excel that you can use. I don't use it because it just changes kind of everything quickly and I want to watch. So I go in and I play with the numbers, but it's a tool that you can use to say that will help you try and define those key levers. Okay. So, investors, everyone in the room pretty much raised their hand and said that they want to raise money. And there's a reason to do this for your business, just so that you can execute and move forward in your business and you know that you're tracking to plan, right? But you're certainly not going to get an investment if you don't have a decent financial model, right? And so what are the key things that they're looking at, right? They want to know that you understand the economics of your business. They want to know that you understand how big the market is, but they also want to know that you understand these levers, right? They want to know that you've gotten to the point where you know if I spend X dollars on advertising a month, I'm going to get Y users. And those users are going to stay with me for an average of 3 years or 3 months or whatever the lifetime value of that is, right? And that's going to help determine the cash business, what your cash needs are, so that they can understand, okay, if I invest $250,000 in your business right now, that gives you a 3-month window, or that gives you a 6-month window, or that gives you this much longer to get you to the next milestone and the next round of investment, all right? And so here's one of the things. A lot of people outsource this, right? You hire Tech CXO, one of our sponsors, and they build the financial model for you, right? You as CEO of this company are going to be held accountable and responsible for it by the investor after they invest. But they're going to trust that you understand the model enough to explain it to them. So you can't just outsource your model and not, if you outsource your model, it's fine. Not against that, but you have to understand the nitty-gritty details and all the assumptions in the model and be able to explain it to an investor, because they want to hear it from you as CEO, not from your outsourced part-time CFO. So you gotta, if you outsource it, you gotta understand it. Any questions about why? Thoughts on why? We actually had a startup chick this year pitch in our January pitch competition, and she had financial numbers that she had shared with our judges, and she could not explain the numbers. She could not explain how she went from X number of customers and revenue year 1 to Y number in year 2. And she didn't get into the program. That was the decision. Uma.
There are some numbers which are very great. For example, the cost of converting a trial user to a paying customer, or converting a lead to a trial user, or converting a lead to a trial user to a paying customer. And there's cost involved in all kind of latent costs, which is not very obvious. And I'm being the first time big business or whatever, and I'm not very savvy on these things. So for my example, I was trying to figure out what is the cost of managing a network node, because I'm trying to price my product and I'm targeting a SMB market, 5,000 nodes, a data center 5,000 nodes, right? So what is the average cost of managing with other competing software? Traditional. I'm doing non-traditional work, research-based. They're doing traditional ones. The traditional ones are automated monitoring but manual recovery. I'm doing automated monitoring and automated reconfiguration. So it's my thing is very advanced. It's advanced than whatever is in the market. So I go, but for competition purpose, I need to compare myself with traditional software. So I found it was $3 by looking at a few companies. Okay, cost of managing per node is $3. So if I'm doing like 5,000 node product, then 5,000 times $3 is $3,000. So that's what's right. But how much money the customer is going to save by buying my product? Then I needed to find what is the cost of managing a node for a year for a customer. So that number was very great. It ranges from $40 to like $2,000. There is no Gartner or IDC number on that. There is no, I talked to friends who work in data centers or owners, and then they give different numbers. So there's not a way I could arrive at.
Well, your cost is going to be different than your competitor's cost.
Yeah.
Right, so you are going to have to come up with the formula by which you calculate your cost for how much it costs to manage each node.
For the ROI, so in order to convince a customer that if he has 5,000 nodes, he buys my software, he's going to save some.
Okay, right now, we're not talking, what you're talking about is more about how do I market my product based on what my competitors' costs are and my costs to the customer. We're not talking about that. We're not talking about the customer at that level at all. We're not comparing ourselves to competitors. We are looking at the black and white numbers that it's going to take to run this business. So your revenue is going to be in there. Your assumptions about your revenue, how much money you make per node, is going to be in there. And we're going to have to build a formula that determines what the cost is per node. And that might be some combination of, bandwidth, storage, computer cycles, right? In a software as a service.
The thing is, there's no industry standard on these things. There's no Gartner IDC number on it. It's,
No.
You do it on
No, there's no industry standards. You can't go downline a financial plan that's going to work for you right now. It's not possible. We're going to create them from scratch, and it's going to work. I kind of like it. It's kind of fun for me. It's one of the first things I do when I have an idea is I build a financial model. Sounds so scary, but okay. Not a crazy busy one, but it does give you a feeling for how much time and money am I going to put into this business before there's a return from me personally, even if I don't get outside investment. And then I can look at it as like, okay, is this something that would intrigue an investor enough to maybe warrant outside investment, which means I could do it faster.
But isn't that the cart before the horse, though?
What do you
The
mean?
way you say you do it?
When I do it? Yes, it's totally wrong. I should do customer discovery first. You're 100% right. But, let's be honest. I do it in about 4 hours. So I build a basic, fast financial model based on templates that I have that I've used over and over again in about 4 hours, some evening, some Saturday, and I say, okay, that idea is worth pursuing enough for me to think about doing customer discovery. The only time I've wasted is my own. But I have an understanding of what, I go through this thought process, what are the expenses going to be? And most of mine are web and mobile, so there are a lot of similar expenses, but then I can go out and I can research. What's the cost per acquisition of a salesperson, a salesperson to download my app? Who else gets salespeople to buy apps, right? What is their cost per acquisition? Can I find that out? I can find that out, I can add that in my model, and I now have an understanding of what it's going to cost me to get users, right? Because I already know how much it's going to cost me to build it, because that's what I do. But yeah, so it's crazy.
It's a minimal viable spreadsheet.
It's a minimal violation.
That's exactly what it is.
Yes, that's me. Crazy.
So Jennifer, you saying that even if we have an existing financial model worksheet, so we're still going to have to break it out for the employee side as well as...
So if you already have a financial model and you want to use it in this workshop, you are welcome to use it. What we're going to look at and what we're going to talk about is whether your financial model is a bottoms-up financial model or a top-down financial model. And 9 out of 10 of the ones that I look at, prepared by our virtual CFOs in this city, all of them, are top-down. And they don't really have the assumptions behind them. And so if you want to think about this, right, what is an investor really looking for? It's a guess, right? It's like that when we first start. It's all guesses before we go out and talk to customers, right? Your financial model is a guess. It really is, right? But did you go through a logical thought process and do enough research that you can show an investor that you've thought about every possible scenario? That will impress them. And they'll be like, wow, okay, they've really thought of everything here. And right, especially angel investors, right, they always want to add value, right? They're not just writing your check and walking away. So they're looking at this and they're going, based on the market and based on the financials and based on who your team is, this is a team I can get behind. They know what they're doing, or they seem to be on a path towards knowing what they're doing, and I can help them. I have connections and things aside from the money that I can contribute to this team to make them successful, right? So it's really about just showing that you've gone through the thought process and understand how your business works from a monetary perspective. And with that, I'm gonna turn it over to Mary. I'm not the expert talk to us. I'm just an entrepreneur.
Thank you. My name's Mary Miles. My background was corporate finance and accounting for many years, and then I met my other half, who was a serial entrepreneur, and he convinced me that there was a better life out there besides sitting in a cubby or sitting in an office all day long doing numbers. But I actually love sitting and doing numbers. If you did nothing but stick me in a room with spreadsheets and financials and let me do that all day, I'd be perfectly happy. And I know that there's probably other people in this room that secretly wish that they had become accountants or financial analysts. Anybody wish they had become? No? Nobody. Actually, accounting is kind of boring. And I know a lot of you are here thinking this is going to be the most boring class you've ever sat in, because it can be. And I think I hope what you get out of this class is that by financial modeling, and that's what we're going to end up doing by the end of the third week, you can actually put your information in there, tweak it, change the numbers, get more information, add it, and then you can actually start seeing the results. And that's what is exciting. It's the plan for the future. You build this financial model, and you can see where in year 2 and year 3 where your business is going to go and how much it's going to cost. And you can get really excited about that. And that's what I love it. I love this modeling process. Let's see. Why do we have financial statements? Jen went over a lot of this already. And the way the finance world has been controlled by accountants, we've made it really confusing. We've changed the language so nobody else can understand it but us. We use terms that are kind of ambiguous. We have 6 different terms for the same thing. You'll see profit and loss statement, income statement, and a statement of revenue. They're all the same thing. But we like to, I don't know, maybe it's because, the British finance people have certain terms and the American finance people have certain terms, and we've changed it. So I'll try to go over some of those terms with you so it's not so confusing. The other reason that we do the financials, the way we do it, is consistency. There's a group of accountants. They make standards so that all the financials are prepared the same way, so that when you have company A and company B and you're looking at their financials, you can compare the two. There's a standard for how it's set. And so that's something that you'll try to keep the standards. And the idea there is like things go in the same bucket. So if you have payroll expense, all the payroll things go in the payroll bucket. If you have travel expense, all the travel stuff goes in the travel bucket. So that way, when I'm comparing your payroll to her payroll, I can see who's doing better at managing their payroll. There's time sensitivity to accounting. We don't allow you to put a revenue without the cost. And you'll see, if I make the sale, if I buy, I'm a bookstore and I buy a book and I sell the book, I can't count the revenue without counting the cost, because then it just looks like I'm making a whole lot of profit, but someday I'm going to get hammered by that cost. So the whole thing of time sensitivity, I might have bought the book a year ago, but I just sold it. But I count that sale and that revenue at the same time I count that cost. And we'll get into that in a little bit more detail.
Isn't that also what got numbers companies in trouble too, when they had like 3-year contracts, and instead of having the revenue go over 3 years,
They counted it all in the first year.
1 year.
And that's, you're exactly right. You see it both ways. You see where they count their revenue in one period, but then their costs are coming later.
Exactly.
And it's not supposed to be done that way. And a good example of people that tried to change the rules recently was Groupon. When Groupon went public, they said, well, we want to put out our financials a little bit differently. And so what they did was they said, we're going to take all our marketing costs, and we're not going to put that in our profit and loss statement. We're going to keep that separate. We're actually going to try to capitalize it. And it made them look very, very profitable. However, nobody else is allowed to do that. So when they said to them, finally, they said, no, when you do your financials, you have to do them just like everybody else. Yeah, you have a lot of marketing costs. That's part of your business, but so do a lot of other businesses. So you have to put the, and suddenly they didn't look so profitable. And now in hindsight, and if you look at what's happened with Groupon, you go, oh, no wonder they wanted to hide that cost. You know? Well, so, you know, they probably saw out into the future how this was going to play out, and they were trying to make it look better than it really was. I won't get into the whole debits and credit and two-sided entry and all that stuff, because that's the stuff that accountants just love, and how you record everything, because hopefully you're going to have either software that does that for you or a person that helps you with that, because we don't have enough time in this class to get into how accounting is recorded and every transaction is recorded. But I'll just say that, and you'll know this, it has to balance. And you'll see when we get to the financial statements, the balance sheet has to balance. So that's just one of the rules of accounting, and there's a reason for that, and that's so that you're not recording one thing here and not recording something there. So it helps, it's your check. It's to make sure you've recorded everything right. Okay. Here's an example of an income statement, and I'm going to get into these terms, and we can kind of look at this as we're doing it. I made a financial statement for a pretend company, and my company was the Pet Tracker. I thought it was a great idea until I realized that there's about 20 other pet trackers out there already. So, but I just made a very simple financial statement, which you have. We're not going to see it up here because it wouldn't fit on the screen, but you're going to see an income statement. See, that says income statement, but if you look at mine, it says profit and loss. That's what we do. That's accountants. We like to make about 20 different names for the same thing. Basically, this is the statement that's going to tell you, did I make money this year? Now, this isn't cash. This isn't the cash you would have made this year. You might not have ended up with, he's actually lost money. So, but you, in my example, it's net income here. You might not end up with $100,000. Sorry?
That's a startup.
Oh, yeah, that's okay. This is not, this is startup. You might not end up with that much cash. That's the cash flow statement. And we'll look at that in a minute. But this gives you, and this is a good example of a startup. He's got revenue. He or she has revenue. There's the cost of the revenue. That's the direct cost of the product. And we'll get into all the details here. But it's an example of what you're going to build. And you're going to be able to see this for yourself. In time, if you have 2, 3, 4 years of these numbers, you can see your progression. You can see how you're growing. You can see your percentages of revenue. That's something we also do. And I added some stuff here for you to look at later, some formulas and percentages and tests that you can run on financials to see how you're doing. But that's an example of the income statement. The balance sheet. The balance sheet is the thing that always has to balance. Your assets, which is the top part of the balance sheet, those are the things that you own. You own your cash, you own your vehicles, you own your computers, you own anything that somebody hasn't paid you. You've given them a product, but you've got a receivable. You own that. That's what you own, and that's the asset. The liabilities is what you owe. So you own it or you owe it. You owe something, that's your liabilities, that's your accounts payable, maybe the bank loan. And then stockholders' equity, that's what's been invested. So it's what you own, what you owe, and what's been invested in the company. And then along those lines, over time, under the stockholders' equity is the performance of the company, because it either gets reinvested in the company, or the company has to pay more money because it's losing money. The statement of cash flow, the cash flow statement. That shows you how much cash you gained or lost during the year. This is what Jim was talking about. For investors, a lot of them, they will look at this statement because you're going to project it over time. You're going to show over time how much money you're going to need. You can see at the end of the first year that you're going to need $225,000 to stay afloat because you're going to not have, you can't do negative cash. You have to get cash from someplace to pay those bills. So you're going to show, when you build this, your cash flow statement is the best spreadsheet you've ever seen because you fill in the blanks and it's going to automatically build a cash flow statement. And when it does that, you can see in year 1, I'm going to need $50,000. In year 2, I'm going to need $100,000. In year 3, I'm going to make money. So I'm not going to need any more investment. And it's a beautiful, beautiful model, the spreadsheet that Tom built. So that's our cash flow statement. And it is my favorite as well.
I like to look at it monthly versus.
It is, well, I mean, if you look at it monthly, it's the runway or the burn rate. We have these terms that we use for if I don't have enough runway, my plane won't take off before I get to the end of the runway. My burn rate, how much cash am I using every month, and how much cash have I got in the bank? How many months have I got left? So you don't want to wait till you've got 1 month of cash left to go raise money. It's not enough time. You need to see that, and you can say, oh, I've got enough money to last a year. I can get in 6 months, and if I'm still on that progression and I'm starting to make my numbers, then you're okay. But if you get 6 months into it and you're burning money a lot faster than you thought, or your revenues aren't coming in as fast as you thought, you get out there and start raising money. Okay, income statement. And here's where we're kind of going to look at the docs that I gave you. So I gave you an example of an income statement, and then, or profit and loss statement. And then I have the definitions of the terms. So the idea here is to get you familiar enough with the terms so when you're talking to outside people, when you're talking to an accountant or a banker, angel investor, even your employees might want to know how the company is doing. You can understand these terms. This is also part of this. When you're building your business model, you're talking about revenues. You found your customer, you know who's going to buy your product. You have an idea of what the market is. The question is how much are you going to sell it for? How much is this product going to cost your customer? What kind of relationship are you going to have with them? Do they pay you in credit cards? Do you get your money right away? Do you give them terms? Do you take 30 days for them to pay you back and you send them invoices? These are all things that you're going to want to know when you start building your financial statement because that determines your cash flow. How much cash do you have? If you're getting credit cards up front and then delivering a product, that's the best. Get the money up front. That's money first, it goes a long way because then you're not having to spend money and then wait for your money to come in. So when this revenues is also called sales, it's also called net sales. It's when you deliver a product or service to a customer. And it doesn't matter if they pay you yet. You can give them credit, and then that becomes a receivable. But it's still a sale. The timing on this is you count it as revenue, you count it as a sale when the product's delivered. So you might go to contract with somebody. You may have a deal where you're going to supply them with a software. You're going to build a website for them. And you have this contract, a purchase order. You don't count it as revenue until you finish the website and you've delivered it to them. And then you invoice them or get their cash. Even if they prepay you, like an example of a 3-year contract, they pay you up front. Technically, you're not supposed to count it as revenue until you've delivered the product. Now, if you deliver 1/3, 1/3, 1/3, some of these cases you can count 1/3 of it as revenue, depending on how the contract's written. But you're supposed to, when you deliver the product, is when it counts as a sale. Cost of revenues, I've got to say, is one of the most important things that you're going to work on in this spreadsheet because you may sit and think that you're going to make a lot of money on something and not realize what it costs to make it. And I've seen that many, many times, that, not so much in maybe the app world, but that's in the development side of things. But you may have a vision for a consumer product. It's actually, my pet tracker. I thought I could go make this pet tracker. It's a collar that I put this GPS system in, and I thought I could sell it for $50. And then I run my cost, and I go get the actual cost it takes to make it, and I find out that it cost me $45 to make the product. Once I do this financial model, I'm going to find out that between marketing and labor and management and delivery and all those other things that I've got to do, I'm not going to make a profit. And I might just say, never mind to the pet tracker. Somebody else's, I'd have to, or at that point,
Having technical challenges today.
I would just raise my price. Maybe my price is too low. And that's something that you can do in this financial model that's also very, very sweet. It's, let's say you build your financial model and your profits aren't what you thought it was. You can tweak the numbers. You can go in and you can change your revenue number just to see if I raise my product price, $5 or 50%, see what it does to my model. I might see that that's going to help. But you also have to know what the market will bear for that price.
What if you don't know what your cost should be?
What do you mean
You're
as
not
far as
selling-
the industry
You're not
goes?
selling widgets yet.
You're not selling widgets, is it?
Right.
So you're selling a service,
Yeah.
and so you want to be in line with the industry. And if there is no industry, you've got a new industry. You're going to do the service yourself. You don't know what the cost should be. It may be. You know what the market is as far as what you can sell it for. You want to know the cost so you can come up with a price. I mean,
Gotta come up with a price.
Yeah.
And the issue is, do you undersell? You need to start with underbidding yourself, underpricing yourself.
you could as part of a knowing, but see, you'll know what your costs are, because if you're underpricing it, you should know. You should be able to build your costs, though. If it's labor, you should be able to figure out who am I going to hire and how much I'm going to pay them. If it's another service that you're going to buy and resell, you should be able to come up with that. You should be able to come up with a cost, or at least a very good idea of what the costs are going to be. In a way, it sounds like it may be project-based, which this model that you're going to see, it doesn't really work well with a project-based. In other words, every job I do is going to be a little bit different, because I'm going to take on projects, and it may be a little bit different. Your project takes longer than the next project in this. So I would try to work on an hourly rate, or a day, or you'll see when we build the model. But
Okay.
you should be able to come up with a cost, and from that cost, you can do cost plus, but that's tough, because if you take your cost and you add margin that you want to make, you may price yourself out of the market. So you have to know what the market will bear for your product. Am I making sense? Is everybody awake? Okay. So now we're talking about, that was our cost. I'm sorry, I get to keep up. Here, we'll go back to the revenues for a second, because depending on what your business is, there's things that you might not have thought about that are revenue generators. And these examples are subscriber or page views. You get paid every time somebody comes and looks at it, because you get advertising dollars. So you got to think about the revenues for your business. Cost, here again, bandwidth, materials, labor, the cost of sales. Go with that. We will talk about, when we build the model, variable cost and fixed cost. And that, we're not going to get into it a whole lot, but there's certain things. When you hire an employee and you're paying that wage every week, that's fixed. If you didn't sell anything, you're still paying the employee. If you didn't have any revenue, you're still paying the employee. But if what you're selling is something that you're buying and reselling, and you when you get an order on the phone, you buy it and you resell it, you know, those websites that they just basically drop ship things. You don't have any expense until you sell it. That's a variable cost. And we'll get into that a little bit more. But that really has, that has a lot to do with when you start making a profit. It's called the break-even analysis, and we'll get into that as well. Does it sound like I'm talking Greek? Go ahead.
If you use contract labor, is that a fixed or variable?
Well, it should be variable if you're only hiring them when you need them. So if you've made an agreement to pay them, you know, $1,000 a week, no matter how much business you have, that's a fixed cost. But if you made a deal with them and say, when I get a project, I'm going to hire you, and I'm not going to pay you unless you're working on one of my projects, that's a variable cost. And that helps you with your cash flow. Because a lot of times in new business, the revenues go up and down a lot. And if you put a lot of fixed costs in there and your revenues are doing this, it's really hard to cover those costs. When you hire maybe somebody that's temporary, part-time, outside labor, contract labor, it can help. But you pay a premium sometime for that. Okay. I'm sorry.
The accounting itself, for a small business, say, when I say small business, a company of size 10 people,
Right.
What is the protocol? Like, is it something you need a part-time accountant or a full-time accountant?
It just depends on how much knowledge you have and how comfortable you feel doing your own accounting. QuickBooks is not really tough. It's, you know, and they've improved it over the years. So you could set up your own financials. You could have somebody help you. There's these CFO agencies that you can hire a CFO, like CTO agencies, a CFO agency. You can hire a CFO to come help you, and you pay them an hourly rate. So they work with you 1 hour a week or 2 hours a week. You don't have to hire somebody, you know, and say,
The past model was I put everything in a spreadsheet. I don't
Yeah.
And then the accountant office, they collect it, and then they're like my part-time, they do my taxes, they do it.
Beautiful.
So I don't have any time full-time or part-time. I just drop it off in their office or they email them. the spreadsheets.
Beautiful.
That's a past thing. It was very simple.
yeah, and I like that model.
I know that there are people who do like envelope system. Like, you know, you don't even have keep a spreadsheet. You have envelopes, just put it in, and they end up with
Yeah.
add up. But you know, that's the simplest model. But in future, I'm going to do something more complex. So I want to know. I won't have money to hire a part-time or full-time accountant.
Right.
So if one of us have to do the accounting, like we're going to 6 people, so one of us are going to be doing accounting. We better do some training on QuickBooks or
QuickBooks is good.
If you're running a technology company and you're doing spreadsheet, is it something out of the league? I mean, is it okay to use spreadsheets? What is?
Well, if you're, this is, you know, I probably shouldn't say this. If you're a private company and you don't have stockholders and it's just you, and you don't have to do books. You know, I mean, you can just run a checkbook, you know, but the problem is, at some point in time, you're not going to know if you're making money, how you're making money, you know, what's going to happen next month. You have no visibility. I look at the financials like the health of the company. And if you don't step on the scales, you don't know how much you weigh. If you never take your blood pressure, you don't know if you have a blood pressure problem. You don't know your BMI. You don't know if your sugar's off the charts. You don't know, you know, your temperature. You never take your temperature. You feel like you got a fever. But I mean, you can measure these things.
Is QuickBooks any better than I'm not used to QuickBooks because I depend on some.
Well, I mean, I don't want to plug a certain software because you know, it's I don't work for QuickBooks. But I mean, it's pretty simple.
Spreadsheet and formulas, and you look at it versus QuickBooks. Is QuickBooks more advanced in creating reports or? You know,
Well, QuickBooks has reports, and it'll save you some of that.
Pay the money for QuickBooks or something similar, it's not worth doing in a spreadsheet. And you, in particular, are gonna have to show your financials to the NSF.
Exactly.
Well, okay,
That's my next
so you need
So
financials.
you, in particular, if you get the grant, are gonna actually have to report back to the federal government on how you're spending your money. So get QuickBooks.
Yeah.
That's exactly my question. My next question was to how to, you know, deal with reporting to grants.
Yeah.
I started that way, and it was okay at the very beginning, but as soon as you start adding components, it gets more complicated. You end up almost building your own QuickBooks. So I say, I paid $235 got the software in the class at Kennesaw, and it's just easy because you put everything in.
It's a pretty simple process. And there's people that will help you set it up, you know, for a fee. There's people that do this stuff, and they love it as much as I do. If you don't love it, you know, you can let somebody else do it. Let's talk a little bit about, anybody have any other questions? I don't want to cut anybody off. Let's talk a little bit about gross profit. Gross profit is your revenue minus your cost of revenue, cost of sales. This is a number that a lot of people look at. And the idea here is, how much money did I make selling my product after I, take my direct costs out? And that margin or percentage is, if you're in a standard industry, there is a standard number that's out there that people are looking for. It's a measure. And in my document here, I said, you should be around 50%. It depends on the industry. I know in the grocery industry, their margins are very small. They sell a lot of groceries and it's high volume, low margin. But you want to know what your industry number is for gross profit, and you want to be there. I've worked with a company recently. They were running at about a 30% gross profit. They weren't making any money. And we looked at it and we said, you need to be 50, 60% of the gross profit because you have a lot of other costs that you have to cover. And without that, they were spending too much to develop their product, to make the product. We found ways to make it cheaper, not the product, but the time, and they're on their way. Operating expenses. This is also called a lot of other things, but you'll see selling, general, and administrative, or SG&A. This is really all the other overhead expenses. Marketing costs are in here, advertising, office rent, telephone, internet bills, as long as they're not part of the product. Travel insurance. Research and development came up in our last class. We talked about that. In your early stages, you're going to have a lot of research and development, and so you're going to see probably higher operating expenses, but it'll be a large number at the beginning, and that's why you do your plan, so you can see as that number goes down and your revenues go up. Any questions on operating expense?
Is that because a lot of these are more fixed costs now?
They can be. They can be. Not necessarily. I mean, a lot of companies don't have to have an office, but an office is a fixed cost. So once you sign that lease and you go in that office space and you're paying that amount every month, you're going to have to come up with that amount every single month. That's a fixed cost. And and along those lines, salaries, you hired employees that you're paying a salary to, that's a fixed cost that I've seen a lot of young companies get in trouble because they get the office, they hire all the people, and then it eats up all their cash. So when you do your plan, you'll see, and I love the spreadsheet because in that spreadsheet it's got a place for your employees, and you can put the date that they're going to start, and it'll actually plug that in to the 3-year plan and shows when that money starts being paid out. It's beautiful. And so you can play with it. You can say, I might need my CTO in 6 months, or I might need them in a year, and you can move it around and see how it affects your cash. I like that spreadsheet. Other things that are in the profit and loss statement, one of them is depreciation. And this is the accrual method. This is, the way accountants can compare year over year and company to company. You buy a large asset, and if we took that as an expense, you bought it, you wouldn't show a profit at all. So we say, take that asset, divide it by the number of years that you expect it to live, 3 years, 5 years, 10 years, and then just take 1/3 or 1/5 or 1/10 and charge that to the current year. Depreciation is a way to allocate the cost of a large asset.
How do you determine if it's 1/3 or 1/5?
There's standards, and it depends on what the asset is. It's out there, and we go by the government standard because you might as well, there's different ways to do it. Tax versus I know, sorry. This is what we get paid for. We make so many different rules, it's confusing. But you can go online and see what the different assets classes are and how they're depreciated. I even look them up. So, I mean, like cars are 5 years, sorry?
Is there a website or just?
There's tons of them. I mean, you can just Google, asset life and it'll come up. Sorry. This lady had her hand up first, sorry.
Oh, I'm sorry.
It's okay.
Because things change constantly as far as asset life and other tax accounting rules, do you recommend to have a new QuickBooks, or to purchase a new QuickBooks every other year, or?
You can do updates with QuickBooks, do the update and pay for it, yeah. The life on assets doesn't change very often. It hasn't, I'm hesitating because like computers used to be 3 years. I'm not sure because I haven't done it in a while if computers are even 3 years anymore because a lot of them, their life it's fast, Real estate's like 20 years. Land, you don't get to depreciate because it's not gonna, you don't have to replace land. But that's the idea behind it, is just spread it out over time. This is one of those things that you'll see in the cash flow statement. Depreciation doesn't cost you cash. In other words, I bought this asset 3 years ago, but I'm still taking depreciation on it. It's going to affect my P&L. I'm going to see that in my profit and loss statement that I have a reduction for that asset. But it didn't cost me anything this year. This year, that cash, that's one of the reasons P&L doesn't match cash. Does that make sense? Don't lose you? We'll see. We'll see. Okay, now we're getting to the good stuff. This is your operating income. And once you take out everything, all your expenses, now operating income doesn't take out interest that you're paying on a loan or taxes that you pay to the government. So operating, and that's because those things, it's a different measure. I want to measure two companies based on their performance, whether they had to borrow money or not. I just want to measure those two, so I look at their operating income. And this is where you see, I'm making money. You'll see in your spreadsheet, I'm starting to make money. This is the place I can see year 2, I'm making a profit. EBITDA, we call operating income EBIT, E-B-I-T. Earnings before interest and tax. And if you watch CNBC, you ever on TV flipping around and CNBC, and you see them, they're talking EBITDA and EBIT and all these other terms. It's just an abbreviation for, this is earnings before interest, taxes, depreciation, and amortization. Depreciation and amortization are those things, they add them back. In other words, they put them back to see how well you did because they know that's not cash.
So they put that in, so this is after the operating expense and depreciation.
Well, and then in this case, they add back the depreciation.
Taxes and interest. Also.
Yeah. EBIT is before you reduce it for interest and taxes. EBITDA is before you reduce it for interest and taxes. And I add back the depreciation because I want to see how I did, not including that reduction for depreciation. Amortization is just the same thing as depreciation, except for it's for an intangible asset. Let's say you bought a patent. You don't have anything but a piece of paper, So the asset is intangible, but you own that asset, and we give it a different name because we like to do that. It's the same thing. It's just a different name. So, and these are terms you'll see. You'll start. Once you get into doing a little bit of the finance stuff and you're on CNBC and they're talking about companies and their EBIT and their EBITDA, it's all because they're trying to measure 2 companies the same way, 10 companies the same way, 20 companies the same. Everybody has to be measured the same way so we know how they're doing. And when you're a big company and you've got lots of stockholders, your job as the future CEO of this huge company is going to be to predict EBIT and EBITDA. What's my EBIT going to be, next year? What's my EBITDA going to be next year? And you'll be talking about what you expect, and that's how companies get measured. Net income is finally, we're going to reduce. We're going to take everything out. We're taking out the interest, we're taking out the taxes. And this is the number that there are industry standards for your business. There's probably a number out there that companies or investors are looking for as a percentage of sales. And you hear that all the time, the percentage of sales. All the companies I ever worked for, our goal was to make 20% to the bottom line. This is called the bottom line right here. 20% to the bottom line. And then if you own the whole company, guess what? You get 20 for every dollar of sales, you get 20 cents. That's a good number. You know, so if you can build a business where you're making 20% to the bottom line, that's good. And my pet tracker, I made 21%, which was pretty phenomenal in year 2. Actually, it's not realistic at all. And then, you know, when we go through the financial models, so the last class, you'll bring back your financial models. You'll sit with a coach. Some of you will be lucky enough to get me. And we'll go through that, and we'll look at it and from a logic standpoint. We'll say, you know, you're making 20% in year 2. You actually made money in year 1. That's not very realistic. Let's look at your numbers and see, what did you forget? Or maybe it's better. Maybe you should have made better money than that. Okay, so any questions on the profit and loss statement? So you have an example there. You're going to build your own profit and loss statement. You're going to play with the numbers and tweak it. The main thing you want to do is remember this. Who's my customer? How am I going to get my revenues? So if I have to spend marketing dollars, I want to capture that here. How are they going to get my product? How am I going to transport it? Stuff like that. And you've all taken this class, right? Okay. All right. Balance sheet terms. What's the balance sheet? We kind of said this before, but I'll say it again because you might remember this one thing. The balance sheet is what you own, what you owe, and how much has been invested in your business. So what you own. Can anybody give me an example of an asset?
Accounts receivable.
Yep, car, accounts receivable. What's my favorite one?
Cash.
Cash. Cash is king. Cash. Cash in your bank account, cash in your petty cash, cash in your savings account, cash. This is the company's cash, not your personal cash. That balance sheet is just the way it's been laid out forever. We lay it out that way so that you can easily read it. We did it in order of liquidity. So the most liquid thing comes first. Cash is the most liquid asset you have. The least liquid thing comes last. And you can kind of see that here on the pet tracker balance sheet. Accounts receivable is pretty liquid. If you got accounts receivable, you can go to the bank and you can borrow money against your accounts receivable. Inventory, you have to, if you had to raise some cash, you might be able to sell your inventory quickly.
Did we skip assets?
Oh, I guess I did. I'm sorry. There you go. Sorry. Accounts receivable, inventory. How many of you are going to have a product that you sell where you would need inventory? 1, 2.
Like hard goods? Are you talking about hard goods? Or?
Yeah, hard goods, parts. So how about an example of something you would have in inventory?
Some nanopots.
I don't even know what that is, but it sounds good to me. You guys probably know what how about you?
Metal parts, you said.
Metal part, I'm sorry. I thought you said nano parts, and I was like...
Nanopots, sorry.
Okay, sorry.
I'm going to have a piece of computer hardware.
Computer hardware, okay. So you're going to actually have inventory you're going to buy in advance. Then you're going to get a customer, and then you're going to ship it to the customer. Or you're going to build a product. So you're going to actually build a product.
Yeah.
So you buy the metal parts, you put them in inventory, and then you build the product, and then you sell it to a customer. And in this case, your inventory is going to have 3 different phases. You're going to have a raw material, a work in process, let's say at the end of the day, you haven't finished it yet, and then you're going to have a finished good. So those are the way we track inventory. And then when you finish it and you sell it, that cost goes to cost of goods sold. Fixed assets, we've discussed. Inventory, investments. You may have some investments where you have loaned money long-term or put it into a CD or something like that if you have.
So, so the loan could be both asset and liability?
Right. If you loan money to somebody else, it's an asset. If you borrow money from somebody, it's a liability. But it's fun. You'll see the name loans in both places. Any questions about assets? Everybody's kind of got that one. And you'll start your company, when you set up your balance sheet for the very first time, you will list your assets, and it's the things that you have put in the business.
Can software be an asset?
Yeah, if you capitalize it, and it depends on how much you spend on it. There's standards out there. If you spend a lot of money on an asset, you can capitalize it. If you don't spend a lot of money on it, you don't capitalize it. It's usually a couple $1,000s
You
in there.
develop software and have not marketed it before go to market, that you consider it an asset?
Now this is something that you've bought this is something you built with your time.
You know, this is example. If I have software I'm building, but I'm not taking it to the market yet, maybe I'm going to be taking it to the market like in the fourth quarter, third quarter from now.
Right.
So at this point, would it be considered an asset?
No. If you're developing a product and you're spending your time or your employees' time to develop a product, it's an expense. And this is a really good question because this is one of those questions that's out in the finance world that they readdress it all the time. Microsoft builds Windows and they spend a lot of money to build it. And you say, well, can't they capitalize that? And then as they sell a product, that cost goes into the cost of sales.
Yeah, I mean, if hard goods can be assets, why not software?
Why not? And I agree with you 100%. It doesn't really make sense to me, but the way that the standards are now, you expense R&D development costs as you're incurred. So it looks very heavy in the beginning. Now, example is Microsoft now makes a lot of money on stuff they developed a long time ago because they took that expense, and so they have high profits on when they sell Windows because they don't have a lot of costs. The cost is the disk or the download or the bandwidth to get it over to your computer, and it doesn't make sense. It doesn't. I'm sure that the lobbyists are part of why we do it this way. I don't know. Yeah, we'll get into politics here, and I don't want to do that.
So if I have 5 developers working for 6 months to build my first product, all that expense goes into the R&D bucket. Okay,
Yeah.
as an expense, and you can't amortize that either?
No, not right now. Yeah, but along those lines, if you bought a software from another company
Right.
and you paid that same amount of money,
Yeah, if I
That's a
bought
capital-
Microsoft CRM to run my CRM for my company.
That's a capital
I can
expense.
Capital expense.
yeah.
What if you bought the software from a software company and develop it for you, that made it for you? Is that, can you capitalize it?
If you paid like in one lump sum and you own
Yeah.
the software,
Yeah.
you can capitalize it. But if you just paid them a contracting fee to do some development, you can't capitalize it. I know.
So essentially, and I'll use a CRM example, so you can capitalize Microsoft CRM because you're putting in, you're buying a license and you're running it.
Is that a monthly, annual
No, it's
license
annual.
fee?
It's not even annual, it's a license fee. You buy it once and then there's a maintenance fee after that. It's a traditional software license model.
Okay, I'd have to look at that, but
And
yeah.
versus Salesforce, which you pay for usually by the month. That
Right,
would be an
it's
expense.
expense. And yeah, and the license fee, it's very technical, like if you can transfer it or if you know, and stuff like that,
Yeah.
so.
What if you pay yearly for the software?
No, because one thing about an asset, it has to have a life more than 1 year. So if you're paying for it on an annual basis, it's an
And
expense.
you get a year's worth.
It's every year, you just expense it. Now, for your financial purposes, you know that you are going to use it every month. And you may want, and this is so technical, I probably shouldn't even go there, but you may want to charge it monthly. Give yourself a monthly amount so that your month looks even. that that's an expense you have every month, because what's going to happen? In January, you're going to have a big expense, and then you're not going to have anything. And then January, you're going to have a big expense, and not going to have anything. So every year, you're going to go, gee, I don't make a profit in January, but I do great the rest of the year. That's because you're paying a big license fee. So, I mean, you can allocate stuff out within the year, just for your own purposes.
Can we go back to the Microsoft scenario? Say, for instance, you said that upfront they had a lot of incremental costs, operating costs because of the development of the software, and now they're reaping the rewards from their previous labor.
Right.
But since everyone is using Microsoft, it is a well-received software. If another company goes and develops their software, well, they won't have the same, I mean, they may have the same rewards as Microsoft, but can they expect a similar reward if they develop it up front? They may not have a mass market as a Microsoft.
But when you do your model, let's say that's your business. You're going to develop a software, and you're going to sell it to, it's a SaaS, and you're going to sell it. So you have a lot of development costs up front. You'll see when you build your model, and we talk about the cost of sales and what that cost is, it will be a lot lower cost of sales because in later years, because in the early years you have a lot of development costs that goes to operating expense. But you'll see, and you should. I mean, that's what I said, the industry standards, when you look at the profits, you can go pull some P&Ls off the internet, you can pull any public company you want, and look at what their gross profit is for Microsoft or some other Cisco, the high-end software companies. They have a lot higher gross profit than a Macy's or a retail establishment, or grocery stores are terribly low. You know, compare the industries, and you'll see that that's the software. They take the hit up front. They pay the costs are up front. Balance sheet. So we did assets, we did liabilities. And to make the equation always balance, because we always have to balance, we have the stockholders' equity. The stockholders' equity are either the preferred stock or the common stock, also known as, because we like to do this to you guys, inside stock and outsider stock. And the terminology here usually works. Preferred stock, outsider stock, that usually means there's no voting rights. They get guaranteed amount of returns. We can get really, really technical here. You'll find that when you're talking to investors, some of them want preferred stock and they want voting rights. So, Jen and I have talked about this. It's like you can make these different types of definitions for stockholders and types of stock. So I don't really want to get into that a whole lot.
And we'll talk a lot about this in the investor readiness workshop later this summer. So
Right.
that's the entire focus is on that kind of stuff.
So when you build your model, just think of it as inside stock and outside stock. And that's the way I've set it up on here. Inside stock being your money, and outside being any outside investors. Retained earnings is you saw our net income number from the profit and loss statement. We take that same number and it comes over to the balance sheet so that we balance. And so retained earnings is that number added up, accumulated every single year that the company's been in business. So in the first few years, you might have lost $100,000, and then in year 3, you made $100,000. Now your retained earnings is 0. You know, it just accumulates so when you look at a balance sheet for a company and you see retained earnings, and you can tell how much money that company has lost or made since the beginning of time. That make sense? And an example, I was going to try to make it simple, how a balance sheet works, and I gave it to you on the bottom of the balance sheet page. It works in your personal transactions as well. Let's say you buy a house. If the house is $400,000 and you put down $100,000 and you borrow $300,000, right? Pretty much let us know how this works. You put in some equity. So your asset is the house, $400,000. Your liability is $300,000. That's your note. And then the $100,000 that you put in, that's what you invested. And it all adds up. Does that make sense? Who's awake? Nobody's awake? No. Okay. So, balance sheet, when you go to prepare your financials, you're going to want to think about your investors. Where am I going to get money? You're going to think about your assets. How many of you will have to buy equipment to run your business? What kind of equipment?
Some semiconductor processing equipment.
How much do you expect to pay for that?
Maybe like 100,000
Okay.
or 200,000.
Okay, so along those lines, when you're building your balance sheet, you know you're going to have an asset on the books for $100,000 to $200,000, and if you don't have the cash yourself, you're either going to have a note or stockholders' equity. You're going to borrow. You're going to get an investor. So you'll see those two things on your balance sheet. How about
For software companies, there's the hardware, right? The computers and servers,
Right.
simulators. And
so you'll buy the
Only
assets.
if you purchase them.
If you lease them, it's not. But if you purchase them, it's
Only if you purchase them. So if you're going with a cloud provider, you're not purchasing them.
Yeah, if you buy something like software systems,
right. Do you have an asset that you'll be buying?
Editors, edit machines,
Okay. What is an edit?
computers,
Okay.
and software.
Okay. Yeah.
Yeah.
So same thing. If you don't have the cash, you can borrow the money to buy it. You can use your own cash, and there it'll become your equity. That's your equity in the business. When you use your own cash, it's equity.
Can you explain one more time, like how to put this equipment into this stockholders' equity?
Okay.
Yeah.
Let's say when we do the balance sheet, we'll go into it more. When we build the model, we'll go into it more deeply. But you will, you want to buy this piece of equipment, but you don't have the money. So you either go to an investor and they give you the money, which you go buy the asset. When they give you the money, it's going to go into stockholders' equity. So the example on my spreadsheet here, outside equity, that's where that $200,000 is going to go. And then it would probably go into your bank account and go into cash. And then when you buy the equipment, it'll go into fixed asset.
Okay.
Does that make sense? Okay. But it'll stay on the balance sheet. Those are balance sheet items. Okay. How are we doing so far? Everybody wait? Uma.
How much time is this seminar, when is it ending? Till what time are you planning to do this?
1 o'clock, right?
1:30.
1:30, sorry. 1:30.
I need to take a conference call at 1 o'clock, so I'll be sorry.
Okay. Okay. Sorry, 1:30.
So all of our workshops are 11:30 to 1:30, so you need to plan around that? Because when they're really workshops, you'll
Yeah,
lose
'cause
value. I mean, you lose value by...
People will be working
You're going to
one-on-one.
miss out on the cash flow statement, which is my personal statement, so...
I'll try to get some of this cash flow in here.
I'll be okay with this. I have a book on accounting for financial reporting.
There you go.
I got your slides too, so.
I have a question regarding margins. Are you going to get into that?
Gross margins, profit margin, okay, on the profit and loss statement?
Yeah.
Yeah, we talked a little bit about that,
Yeah.
but we can go back to that. You want to talk about it before we start cash flow?
Yeah. If you can get into, because I know there's certain industry standards around that.
Yeah.
But again, if you're in a particular industry that doesn't have that kind of data, how do you approach margins?
How would I approach it? If I was building a financial model and I wanted to see a certain margin, I mean, I do, it's kind of like what Jen said, you know, I called it the napkin financial, when we sit at the table and we just write down numbers and we kind of play them out in our head. And we go, you know, I could sell this product for $1,000 to a customer, you know, and I don't know how much it's going to cost, so we start building those costs, and we say, you know, it's a per hour cost for this person, it's some equipment for that, and you keep adding those up, and then you see what that margin's going to be, and you keep tweaking it, you know.
Yeah, because my thought was to go after projections And then also take a look at, we're not in an industry that's commoditized.
Right.
So it's a growth industry.
Right.
So factor in some information and numbers based on that to determine what my margins are, or assumptions based on around that.
Okay, so an example might be capacity. I mean, a thing that you might have to consider is capacity. And we didn't really talk about this, but this is probably going to affect most people that don't build the software and then just sell it. If you're got a service industry, you're going to have capacity issues. And here's the idea. The two of you can probably run the business by yourself until it gets to a certain level. And then you have to add a body, and that's capacity, and that's a cost. You know, now you want to make sure you cover that cost. And so in this model, you'll be able to do that. You'll be able to say, you know, I can only handle 20 customers. And at 21 customers, I got to have somebody else. And at 30 customers, I got to have somebody else. And you can put that in this model. You'll see that, and it's really beautiful. And then you can start to see how that's going to affect your margin, because you're having to add either another contract laborer or another employee to be able to handle the capacity. And I've worked with companies, they get to a certain capacity level, and then they've got to start managing people instead of doing it themselves. And that really affects the business, because that's now you have a management cost in there that you didn't have before. You know, so as you build the model, you want to scale it up enough so you can see what your capacity issues are going to be. Or if you're happy just with 20 customers and that's the size business that you want to have and you just want to stay there and you don't want to grow it beyond that, you can do that too. You can decide that's the model that you're happy with. But there's capacity issues, and maybe in your case it's equipment. You know I can run, you know, this piece of equipment 24/7. I can put in 3 shifts of people and they're running this all day long. But that's the most I can get out of this one piece of equipment, and if I'm going to grow the business beyond that, I have to buy another piece of equipment, and at that point, I'm at my capacity. When am I going to borrow more money? Am I going to have the profits to put it back in the business? And those are capacity issues.
And that's what we're looking at in terms of scale. So
Yes.
based on the scale and when we're going to implement the labor increase to determine what margin.
And that's the beautiful.
We'll start from the bottom up and do it that way.
That's the beautiful thing about this model, and you haven't seen it yet, but
Okay.
there again, you can change the date that you're going to hire the employee. You can just change that date by 1 month, 2 months, 3 months, and keep seeing how it's going to affect not only the business and the profitability, but your cash flow.
Right.
You know, if you're not making enough profit yet because I only have 20 customers to pay for the new person, and you got to ramp back up again. So you might want to do outside labor. You might want to do some overtime. And you think about this in corporate. This happens all the time. They hire a second shift, but then they lay off a second shift, and then they, you know, it's this up, down all the time with capacity.
So you're basically trying to stay ahead of your guesstimations?
You're trying to guess as best you can, and then review it as often as you can so that you can adapt. It is adapt as fast as you can. The winner is the one that can adapt fast. That's why smaller companies can outdo big companies sometimes, because they are more adaptable. You can hire another person or train another person more quickly than a giant corporation can.
And then also understanding what's your sales cycle so you can determine when are we going to hire and when do we need to start bringing on people after a certain amount of sales that have been completed.
Right.
Okay.
Yeah, that's an example of a company that we've recently been working with that had they built Apton, and they had a capacity issue. They have 3 people writing apps, and they got great business. Their business came in, and now they need to get more people to write apps. But the CEO of the company, he's writing apps. He's trying to manage people. He's trying to get new business, and so at one point he has to do nothing but review the software that had been written instead of actually writing the software, and so it freed him up to do other things.
We thought about that.
Okay. So I don't know if that's really answering your question on the margins.
Yeah, it is,
but
because it's saying, you need to anticipate and put these projections in, and then once you determine what the projections in, then you can take a look at what your margins can be by tweaking it.
Right.
So I would also say that I've talked to like 40 new companies a week, and almost nobody has an idea that is like that revolutionary, right? So how many of you read Microsoft saw Mary Meeker's video from All Things Digital, where she did a review of the internet and mobile space. So you should go find that on the internet. It's about a month ago. And she, it's Mary Meeker.
She does it once a year, right?
Does it once a year.
Was she at the National American Association of Broadcasters?
No.
She did? Okay.
This was at All Things D, All Things Digital.
Spell the last name?
Meeker. And she goes through, you know, how many people are using the web and how many people are using smartphones and what are the trends that they're seeing in those things. But then she actually gives like her real visionary talk about this is that we are at the beginning and we're starting to see this, that everything is kind of being revolutionized, right? So, you know, first was we don't really read newspapers online. We read them through Flipboard, we read them through tablets, right? And she talked about, you know, Pinterest is really just a different form of scrapbooking. And, you know, the new thing is like, okay, how we're taking old industries or old niches and recreating them in a mobile and web-based centric world, right? So, but it's, and for a while there's this gray zone about how you're going to make money and stuff like that, but in the end game, it's probably how you make money in those industries is probably going to be very similar to the original industry that you just revolutionized, right? So the margins are probably going to at some point get back to that type of margin that is that industry standard for today. So you can think about that. I mean, especially with you guys, I think that that's
And
what
we
you're
have
kind of doing
approached
is
that.
you're just,
We're seeing that.
you
We're
know.
seeing some of that, yeah.
So I would, Mary Meeker's presentation, I mean, it's worth, there's one, the slides are there, you can download the slides, but it's really worth it. One of the places I saw it, I think it was actually on All Things Digital's website, was they have the whole video with her talking too, so you can see the slides and her speaking, that's really powerful.
Sounds good. I'm gonna look at it, but I
Well, if you read Startup Chicks, I posted about it.
yeah, okay, that's fine.
You guys are all gonna start reading Startup Chicks.
Behind closed doors.
That bottom line.
We'll get some finance stuff on Startup Chicks. So, are you guys ready for some cash flow?
Oh, yeah.
Cash flow. Cash flow. And I have to say that cash flow is, it's one of those things that investors do look at. The idea here is how much money are you going to need? How much, you know, the last thing an investor wants is 6 months after he gives you money is you to walk back in the door and say, you know, I need some more money. That's puts him in a fearful place that he's about to lose his money, or if he doesn't put more money in.
Well, unless it was expected.
There's tiers. I mean, when it's expected.
If he's giving you X amount of money to get to the next milestone that's going to happen
Yeah.
within the next 6 months, and you hit that milestone,
I'm sorry.
he's expecting you to knock on the door.
Yeah, but when it's, I'm talking,
That's what I
yeah.
want to make sure.
But
If it's
how about,
through the 6 months, then you're in
and
trouble.
if he's expecting you in 2 years and you show up in 6 months, it's either real good news or real bad news. You know,
And that's what I couldn't understand, how some of these angel investors would just give people cash. And no idea in terms of making revenue. And
Having a
blow-
plan.
No plan, and blow right through it. And it was like, okay.
and you might see some of that.
Yeah, I'm serious.
I was going to say, and I have seen that in California with people who had great startups, and then they have a concept, and people are throwing money at them, and you used to see it a lot more often. You don't see it as much anymore because this bubble sort of
But it
bursts on
sounds
that.
like it's coming back. Okay, they
If you are one of those individuals who created Google, and you go out in the market and say, I have a great idea, you're going to have people throwing money at you without
But it
reserve.
contradicts everything. Those of us that have gone through a plan that says you can blow through cash and
Right.
have show any revenue and get money.
Yeah, it's
I mean, I didn't see.
a lot of it has to do with the idea. They love the idea so much, and if you're a good pitch man or woman, and they love the idea so much, you have to be able.
Facebook.
Yeah. you might be able to get it. And then the people that gave Facebook money are very happy they did. You know, they are very happy. Maybe they never saw the revenue, and they still may not be able to see how Facebook's going to make that much revenue.
Right.
But right now, they're happy campers.
Yeah, but that's a small percentage based on.
Yeah. And we want ATDC to be
Exactly.
a profitable, builder of profitable companies, you know.
And chip on it.
Yeah. So cash flows. So it's really looking at how much your cash changed over a period of time. And this annual financial statement is what happened to me this year, in a year. And so if you look at the pet tracker, you'll see, and this is where all this stuff ties together. All these financials, you kind of lay them all out here, all three of them, and you can see where we look at the income statement and the balance sheet, and that flows into the cash flow statement. And that's why the cash flow statement tells such a good story all by itself, because it's got everything in here. Okay, so if I'm looking at this cash flow statement, I can see that the net income was $100,000. And I look back on my profit and loss, 100,000. That's 100,800. My depreciation, here's my $7,000 for the year. And so the idea here is I'm looking at the change in the balance sheet. If my accounts receivable goes up or down, it makes a difference to my cash. And here's the example. That income statement is looking at my revenue. And that revenue number is everything that I sold, whether I got cash for it or whether I gave somebody a bill and they haven't paid me. I shipped it on December 31st, haven't been paid for it yet. So the increase or decrease in your accounts receivable is saying, oh, I sent a lot of stuff that I haven't been paid for yet because my accounts receivable went up or down. If I collected a bunch of receivables, that gave me cash. So that's telling whether I didn't get the cash yet or I got cash, and I actually went back and cleaned up my receivables and I got cash from last year. Does that make sense?
Yeah, because it's carryover revenues for some of this.
Yeah.
Right?
Yeah. Same with inventory. If I had a lot of inventory last year and I reduced my inventory, well, my idea is I sold it. I used that inventory, and so I got cash for it. If my inventory goes up, though, that means that I spent cash, and that my cash is now sitting in inventory. That tells a story of what happened to my business. And so if I look at this pet tracker, I'm looking at this, and I see cash flow provided by operations, and I see $42,000. But I made $100,000. I made $100,000, but I only provided $42,000 in cash. That's because I used it to buy some inventory. I mean, I can look at it and I can see I used it to buy some inventory. I also didn't pay some of my bills, so I've got some cash sitting there because I didn't pay my bills off. And that's the thing that you can see. A lot of times you look at an income statement and it looks great, right? This company looks like they're doing fantastic. But if they're not paying their bills, they got a lot of stuff that's accumulating. It could eat up their cash and it could kill them. So you got to be careful there. So that's, the cash provided by the operations is only $42,000, even though I made $100, because I used my money that I made to buy some inventory, and I didn't collect all the money from the people I sold products to. I let my accounts receivable go up.
Are those supposed to be in these sheets?
Yeah, did you not get these?
Oh, we got the sheets, but there's none of these statements.
You only had the first one?
Yeah,
You didn't get the balance sheet?
No.
Yeah.
Yeah. We just got this one.
Well, I'm so sorry. No wonder you guys are looking at me when I'm holding this up, going, where my handwriting's on that button. Sorry. That'll just take a second. Because it's a whole lot easier when you can see it.
So while you got a second, how do you handle that? How do you handle the fact that you have these invoices out there?
Right.
And some of you, I know in my business,
It could be 60,
networks
90, if you're government,
6 months.
if you invoice the government, they're historically bad payers. Certain industry are historically bad payers. In my early accounting career, I was in charge of accounts receivable. I loved it, but it's hard. You have to call the customer and you have to get your money, and you basically, that's your money. Don't feel bad. I'll say it right now. Never feel bad about asking a customer to pay you your money. It's your money. It's your money. I know they're the best customer you ever had. They're 80% of your revenue. You're afraid you're going to make them mad and then they're going to walk away. It's your money.
Well, but what do you have? I have
But I mean-
I have a client now who takes 60 days to pay.
You can build penalty. Sometimes you build incentives. You give them a discount to pay you early or pay you on time. I mean,
It's easy to say. I used to do that with ESPN.
Yeah.
For years, ESPN stood for extremely slow paying network.
Yeah.
They've gotten much better, but for years, it would take 45 plus.
And you have to.
And you can build 10.
You can call them every day, and it doesn't matter. And then big corporations, it's a system, I know, because I was part of that. You know, it goes to this department, then it's got to be signed off by this department. When I was in that company I did collections, we made scientific instrumentation. And our, I hope there's no professors in the room, because our customers were professors at universities. And once they got that piece of equipment, they did not care if the bill got paid. They had their spectrometer. They were so thrilled. They were going to go play with their new toy. And so we were chasing professors to, so basically what we had to do was we had to, between the purchasing department and the professor, we had to walk the paperwork through by phone to make sure that it was signed off and paid. Because it gets lost or they don't want to, they're busy.
One of the things that we're going to do with this business is, under the contract, the client has to pay by credit card.
Oh.
And they are automatically going to be billed. And
There
we're
you
going to
go.
send them a copy of the bill so that we don't have to go.
You don't have any cash flow
So
issues.
much labor going behind the account receivable is to get that and let them know in
So
the contract that's.
credit cards have done a lot to help with that, especially even in corporate. You know, a lot of smaller vendors would, just take a credit card.
On the labor to track this down.
Yeah.
If they don't pay or mess up the actual credit card, then, go out another route.
One more. Okay. Okay. All right, so now you have two more, and you have one that's circled balance sheet and one that's circled cash flow. Okay, let's back up. Let's take 5 minutes to back up. Look at the balance sheet. I am so sorry. Now you can see what you own, what you owe, and what's been invested. So what you own are all the total assets, all the things above the total asset line. What you owe is everything above the liability line, and what you have invested so far. To make them balance, total assets equals total liabilities and stockholders' equity. And that little balance check at the bottom, that's not normal. That's something I put on there, where it says it's nothing, just balance checks, it's just zeroing it out and make sure that I didn't make a mistake. So the other thing that you see here is comparisons year over year. I've got 2010, 2011, and the very far right-hand column, I've got change. And that's something that you like to look at, what changed from one year to the next. This actually, I put it on here so that when we do our cash flow statement, you can see what went up, what went down, and those numbers go into the cash flow statement. So does that kind of, that depreciation number, accumulated depreciation, you can see in 2010 it was $5,000, and in 2011 it's $12,000. That's accumulated, because I only had $7,000 depreciation in my profit and loss statement. So that's accumulated, that gets bigger and bigger until it equals my asset. Okay? little bit easier now to understand what I'm talking about?
Now, are we getting these spreadsheets similar to these? Or?
Your spreadsheet is going to, and I can't go on about how much I just love this Excel
I'll send it
spreadsheet.
out probably Friday.
Yeah.
I've got a really big thing going on tonight, so if I'm a little distracted, I apologize, but it's not going to happen today.
Yeah, and we're going to walk
Also,
through how to fill it out next
copy
week,
of
or
everything
2 weeks.
on
Okay, so
Friday,
if
so you can
if
take a look at
give us
it. We're
the
going to walk
information-
through it line by line on July 11th.
Okay, but if you give us the information by Friday and we already have the numbers, we can.
You can
go
start
ahead.
populating, you can start populating the spreadsheet and seeing how it works. But there again, the beautiful thing about it is, you populate the detail. You don't even touch this. You never touch the financial
When I
statement.
did it from scratch, I built it.
Yeah. You never touch the financial statements. It does it automatically.
Okay.
And it's beautiful. And so as you tweak it, you can see your financials change.
Right.
You change that price. You change your price a little bit because you want to see how it impacts. Let's say you say, gee, if I drop my prices 10% because I want to be more competitive, what's that going to do to my financial statement, to my profitability, my cash flow?
Everything across the spreadsheet, correct? Oh, wow.
Yeah.
Can I ask you another question about margins?
Sure.
Do you think it's wise to do contribution margins for your products too?
And what do you mean by a contribution?
As far as with the yield and the costs and for each product and service?
Yeah, you can, as a percentage of your revenues and your costs to see how much, okay, this product A is contributing this much, product B is contributing this much. Yeah, especially if there's a good mix and you can see, like Jen's example, she had some advertising revenue and she also had subscription revenue, and if you found out that your advertising revenue was 70% of your business and making so much of the margin there, you can see that maybe you can spend more effort in that area and make more money. Does that make sense? You get to do that in this spreadsheet. You get to put in different products, A, B, C, you put in different products so that you can then change the mix. Change your mix on those products to say, oh, I'm selling more of these or less of these. I put more advertising dollars on product A and see what happens.
And also if the rollout is different.
Yeah, it doesn't start till next year.
Okay.
Yeah, you can do that too. Okay, you ready to do some cash flow? So here we are. We were talking about the cash flow. Now you have it in front of you. So there's our net income, right? So we're back to why we discovered we didn't have the spreadsheet. The net income on the first line matches the net income on the profit and loss statement. Then depreciation matches. And we're adding back the depreciation because they didn't use any of our cash. That depreciation is just an accounting process. You can see, if you look at the balance sheet, you can see that the accounts receivable went down $57,000. Sorry, went up $57,000. And $15,000 in 2010, $72,000 in 2011, I increased my accounts receivable. That means of that $100,000 that I sold this year, half of it, more than half of it, is sitting in accounts receivable. I haven't gotten the cash yet. I haven't been paid for that. So that affects my cash flow. I'm had good revenues, but I don't got no cash. And
You can still borrow against that.
you can borrow, and that's why, we're saying liquidity issues. I would, if I needed cash, if I was struggling for cash, I'd go to the bank and I'd say, I've got $57,000 more in my accounts receivable. I've actually got $72,000 in my accounts receivable. And it'd say it's current because they care how old it is.
Right.
It's current assets. I just ramped up at the end of the year. I had a lot of sales at the end of the year. It's current, and I need cash now. Can I borrow it? And they charge a percentage. Sometimes hefty. You have to look around sometimes. But yeah, that's what I would do. Also, my inventory. I bought more inventory. But let's say I was ramping up. I was ramping up at the end of the year, and I know that I've got more orders coming in. So I had to go buy more inventory. It makes sense. And so I look at this cash statement and I go, oh, okay, I can kind of see what's happening with this company. But meanwhile, was aggressive because I'm a good bill payer. If you look at accounts payable down there, I bought a lot of inventory, but I didn't increase my accounts payable but $42,000. So I'm current with my bills. I'm not letting that get behind. I could have. I paid off my bank note. I paid off $60-something thousand in my bank note. Maybe I should have waited a little while. There's a thing. Or paid less, or renegotiated, because now I'm going to go right back to the bank. I had a note, and I'm going to write back to the bank and say I need to borrow more money. So, but that happens, and maybe I didn't have a choice. Maybe I had to pay it. So that gives you an idea of what's happening for the cash flow from operations. This is the model that you're going to do. It's going to show you your cash flow. It's really very cool, and I really like the way he's done that. In QuickBooks, you can run a cash flow. It's a lot easier to use the software than try to do this without it. Does that make sense? Because it depends if it goes up or down, if it's balance sheet or P&L.
For cash flow projection for financial analysts, do you show the paid-in equity, or you just show?
Oh yes, you show in the paid-in equity, and you'll see it in the model that we're going to do. I think that model actually has a monthly cash flow.
Right.
And so you're running along, and you're losing money, and you see your bank account going da 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 da.
Right.
Boom! I got cash, and you get to model when you want to put the cash in from your investor, so you can see that I'm going to get money in June. I'm going to get investments in June. I put that money in the month of June, and then I've got cash again, and so I can run along again.
But if I need to know how much I need, I would run it without the cash in there. That's going to tell me how much.
You run it without the investment first, and then you can see when you really need to go get that investment.
Okay.
And you did that. Your model does that.
So that would tell you if, because we are trying to self-finance.
Right.
But that would also tell you when you need to possibly go get money.
Right.
Yeah.
Yeah, exactly. I mean, you say you got a big contract with somebody, and you're going to have to spend this money up front. You know that you're going to have a time lag between the time that you're spending the money to build the product, getting the cash, delivering the product, and getting the cash from the customer. Maybe up to 6 months. The time you spent, what you spent, and what you paid for, and when you collect that cash. It's just a timing issue, and you need to borrow money or delay paying your vendors or make arrangements with them. A lot of people do that with vendors and make long-term arrangements. Make the cash work for you. That's why this is one of the big reasons why when investors look at companies, like you see the buyouts all the time. Southwest just bought AirTran. AirTran had a lot of cash. Very attractive purchase. They like cash, and there's no better way to get cash like that than to buy a company that's already got cash, and then you borrow money and then you get the cash back. I mean, it's companies get bought out because they have cash. They're attractive. Okay, capital expenditures. Well, if you buy some equipment, if you buy that piece of machinery or that computer, it's going to take your cash. And so here's a reduction. If you sell a piece of capital equipment, it would be a plus here. And then cash flow provided by financing. And here's the example. I don't have it in my model, but if you got money from an investor, this is where that money would go. I actually reduced my cash because I was paying off notes and decreasing other liabilities, paid off some other liabilities. So you can see that my cash was $76,000 in 2010, and now I've only got $36,000. And I talk round numbers. You'll see. I only got $36,000 at the end of the year. And you go, was that good? Was that bad? Should I, held on some more cash? And it's all depending on what the future is. What is my plan for next year? If I have a lot of orders, I know I'm going to be fine. Maybe I'm going to build more cash next year. But that's what, when you build your model and it goes out 3 years, you can see that cash. And cash is king. Cash is so important because the day you run out of cash, talking with a new company recently, the discussion was in 3 weeks, I won't be able to make payroll. And the day he doesn't make payroll, his people leave. And the day his people leave, he's out of business. So cash is king. It's hard to put payroll on a credit card.
So even in your model, even though you had more money in 2010, you had a better balance sheet in 2011 because you paid off your debt? Would that be correct?
Well, we can start looking at some ratios. And yes, debt to equity is a ratio that some people like to look at. And if my equity, if my debt is low, it's another thing that means I'm not all burdened by interest and a looming note. Debt to equity is a ratio. We've only got 10 minutes left, so I don't want to. I gave you a lot of other information here. I know you can't wait to get home and start looking at it. But when you start looking, now you've got these key financial ratios and equations. These are things, now that you have a financial statement, now that you have your financial statement and your numbers, you can look at some of these other ratios, and debt to equity is one of them. Or accounts receivable to turnover, or stuff, working capital. But these are ratios that investors look at. That's how they compare business A with business B, because you're totally different businesses. I don't have a clue what you do. I like you, and I like your, the idea of it, but I really don't know. But I can run a ratio, and I can compare two companies, and I can see whose return on investment ratio, which we talk about all the time when it comes to investment, which one looks better, But I will just point out two things here that we've kind of talked about a little bit. One is called break-even analysis. I was a cost accountant in my early life, and this was my absolute favorite thing to do. And I still do it. I do it for any business I'm involved in. Break-even analysis basically says, when do I go from making a loss to making a profit? I sell 29 widgets, I'm losing money. But the day I sell 30 widgets, I'm making money. And that is a great analysis to do, because when you have that number in your head, you're constantly focusing on making that 30. You're going to sell 30 widgets, I'm making money. And so here, break-even analysis, this is when we talked about fixed and variable costs. But if you know what your fixed costs are, I've got a building, I've got to pay for, in that manufacturing process, it's, that's part of my fixed cost. And then I have the variable cost of each unit that I'm shipping out, and so let's say my variable cost is $10. Let's say I'm just taking a product and I'm buying it, sticking it in a warehouse, and then selling it. So it's $10, but I'm paying $1,000 a month. Even if I'm charging $11 for that thing, and I don't have any other cost but my warehouse, how many of those do I have to sell before I start making a profit? It's easy to get to. I just take that variable cost of $10, put it into 1,000. I got to sell 100, and I'm break even. The day I sell 101, I'm making a profit. Now we know there's a cost involved, but that's very, very simple. The other one that we talked about already too is burn rate. It's also the runway. It's got a lot of names because it's talked about a lot. If you've got $100,000 in the bank, but every month you're spending $10,000 more than you're bringing in every month, how many months have you got before you run out of cash? 10. You got 10 months. And that's burn rate. And I've heard it on elevators, I've heard it in hallways, investor talking to an entrepreneur. What's your burn rate? What's your burn rate? It's a good thing to know. Because his thought or her thought is, how much money do I have to give you to make sure you stay alive? Because That's really, at least stay alive. I'll
So
put that up there.
With the new company, then, you still have to assume or create a burn rate?
Yeah, I would.
Well, unless you're going to fund it forever out of your pocket.
I mean, you may not need, well, you want to know for yourself. You want to know how much cash can I put in this? How much can I afford to put into it? And you have an idea that your revenues are going to start flowing in 6 months. And so you run a 6-month burn rate to see, if I got enough cash to keep us going before those revenues start coming in. But I always play with, well, what if a month slides here or a month slides there, and how much cash am I going to need? I mean, cash is very important. Also put some additional terms on there. This is for those people who really, really love finance and accounting and just want to converse in the hall with other finance and accountants and say those words. But just, so you're just not so foreign to some of these terms. Any questions? We finished early.
Go ahead. Thank you very much.
You're welcome.
Okay, so I will get probably this slideshow and soft copies of the documentation and